Tech giants plan to spend $400 billion on data centers this year, so how can investors take advantage? This is Inside ETFs, and we're talking energy. Artificial intelligence requires huge amounts of power. Data centers alone are forecast to eat up as much as 12% of all US electricity consumption by 2030. That means big tech companies are spending billions, not just on chips, but on the power infrastructure needed to fuel them. Matt Salley is head of investments at Tortoise Capital, and its AI infrastructure ETF aims to take advantage by buying not into the big tech names themselves, but the energy firms and components powering them. Matt, how does this work?
So our strategy is to invest in the companies that the hyperscalers are spending the money with. So we see really interesting value and growth prospects in unknown names, a lot of the storage names or connectivity infrastructure. You mentioned electricity. We see electricity demand in the United States growing by 20% by 2030, so by the end of the decade, which for the last 20 years, electricity demand in the U.S. has not grown. And it's starting to really stress the grid. We're seeing electricity prices go higher. And there's a lot of there's a plethora of ways to play this on the infrastructure side without having to go into stocks that most people already have a lot of exposure to in the hyperscalers.
Isn't there a risk these supplier companies can't build out data centers quickly enough to meet big tech's demands? This week it was reported electronic stores in Japan have limited how many hard disk drives customers can buy because there's a global shortage of memory chips. So just because the big tech money is there, does that mean these suppliers can build the data centers fast enough?
So I think if anything, if we're wrong on anything, or if the market is wrong on anything, it'll be the pace of the build out. However, all we're seeing is we love hard disk drives on the storage side. And what we're seeing are their backlogs are out years now. So we don't necessarily view that as a bad thing. It provides revenue stability or visibility out for years and years, which is not, in our view, reflected in their valuations. And these are names that are not appreciated or widely known across, financial markets.
Well, the excitement over AI has made some usually dull companies suddenly exciting, like the utility companies that provide the power. Can they deliver on promises to keep up with this surge in demand?
I think the biggest challenge especially with the regulated utilities, are residential power prices and pushback from their regulators in terms of those prices having to go up to meet that demand. And what we're seeing are a number of utilities and state commissions are working on alternative rate structures that will make sure that the hyperscalers are paying their fair share of the infrastructure and not, so those costs aren't being borne by the retail investors.
Is this just a short-term play, Matt, while this infrastructure is being built out? How long do you think demand can be this frenetic?
I'd say there's good visibility for at least 10 years, and it may be more like 2 decades. I mean, these are very long-term, huge capital investment projects, and these are the hyperscalers spending the money are extremely well funded, generate a ton of free cash flow. We're forecasting about $300 billion of free cash flow just next year across the big four. So these companies can afford to continue spending. Like I said, I think the one thing where the market may be off, we may be off, is just the pace of how quickly it happens. We don't think that's an unhealthy thing. Again, going back to electricity prices, that's where we could start to see some pushback. So I think a little slower build out would not necessarily be a bad thing.
What if the demand doesn't materialize, though? What if big tech companies realize they've built more data centers than they need?
That's always a possibility. We think that's extremely unlikely. If you just look at the corporate penetration rate of usage of AI, it's extremely low in the United States. We're talking single digits. So as companies see the benefits of efficiency gains from using AI, we believe that the demand was only, we're at the very, very early stages of the demand cycle.
And what if those higher electricity prices that you mentioned lead regulators to face opposition from consumers and local authorities to block the build out of data centers?
Well, I'd say that's where we may see data centers site themselves closer to areas like the Permian Basin or the Marcellus Shale, where there's very cheap natural gas to produce the electricity, which should allow the electricity prices to not have to go up as much to meet that growing demand.
There There are worries, though, across the market, with everyone from Jamie Dimon to David Salomon at Goldman Sachs saying there's a possible bubble in AI. If it bursts, are these stocks safe?
We think our stocks are safe. Again, the free cash flow generation of the hyperscalers is such that they can continue spending. They have, in some cases, higher credit ratings than the United States government. And if you look at the TCAI portfolio, it's actually cheaper on a price to earnings ratio than the overall S&P. So the stocks we're investing in are not necessarily all that expensive.
That was Matt Salley of Tortoise. Don't forget, you can watch more videos on Reuters.com.